Please let me introduce and bring up now Barbara Byrne, the Vice Chair of Investment Banking at Barclays Bank, Mr. Ken Mehlman, the Global Head of Public Affairs from KKR, and our moderator of this conversation, Janet Voûte, the Global Head of Public Affairs at Nestlé. And this topic is on the role of shared value and investors. To get this panel going, I ask you to go into Pigeonhole. Come on up, Janet. And we will take one final question here, and the panelists can react to this. To what extent do you see investor expectations today connecting companies' performance to addressing societal needs? And perhaps no surprise, because I think we know that this is both a topic of great interest and a place where more work is yet to be done. We see some saying not at all, and to some extent. So Janet, let me hand it over to you.
Thank you, Justin. Well, I just wanted to say I'm honored to be here on this afternoon's panel to discuss the role of the investor in shared value. And it's a particular honor because we have some experts, real experts, here with me on the podium. And Barbara has spent her career in financial services, being the vice chair of Barclays Investment Bank, certainly will have great insight. And Ken, with his distinguished career in public service, brings almost as a creating shared value kind of person, bringing a public policy expertise into KKR. So we will learn a great deal from these two individuals. But before I turn over the microphone, the proverbial microphone to you, Barbara, let me just set the stage for a second and talk about how, from an industry perspective, some days we're optimistic and some days we're pessimistic about the role of the investor in driving shared value forward. So on my optimistic days, I know that at Nestlé and many of the companies who are involved in creating shared value, we really believe that companies are successful because they create shared value, not the other way around. It's not, they can't create shared value because they're successful, but rather they are successful because they think in terms of creating shared value, particularly focused on material issues. So those are the days when I'm optimistic, but I get pessimistic when I work together with my friends, my colleagues in investor relations, who then go on a 400 investor roadshow and come back and tell me that 1% of the questions had anything to do with the societal agenda. That's a pessimistic piece of news. But more optimism, there's a new article in the Harvard Business Review published by an academic named George Serafim that actually has done a real deep dive into the market performance of companies that focus on environmental, social, and governance issues that are material to their business. So there's a reason for hope. So what I'd like to do is begin with Barbara and ask how much of an optimist and how much of a pessimist should we be, and where are we on the road to investors really driving the shared value agenda? Because without you, this won't happen. So let me turn it over to you, Barbara, if you can share some thoughts.
I've been an investment banker for 35 years. And I would say that such an assembly as this would not have occurred. I think you're judging yourselves too harshly. And you have a large assembly of people here focused from the NGO and the investment community talking about this topic. And when I started in the industry, it would have just never occurred to anyone to begin to address societal needs. And this, I have seen an acceleration. It's like many things. This is an innovation cycle. It's slow. It begins to scale. There'll be good ideas, bad ideas. There are cottage industries that are emerging. The crisis in finance actually creates an opportunity. Hence, bankers are talking about this. Why do you care about that? You care about that because there will always be financial institutions. They may be big banks, they may be small banks. You can break them up, you can make them bigger, smaller, whatever. They're going to exist. And they will exist in a way that they will be regulated, but they will be providing the lifeblood of economy. If you can have a discussion that speaks to we can do well and do good at the same time, and you're creating and growing economies, we care about that from the financial perspective, because if you're going to be pursuing growth, you have to pursue it where you can have size, scale, and scope. Africa, frontier markets, right? It's interesting, actually, we have a partnership with GSK, which is scaling in Zambia for distribution. And I'll come back to that in a moment as to what we're doing there and why we're doing that. We're doing it, yes, to help, but we're doing it because it's our market. We're there. So are you, and you're coming in on the distribution side. I think that investors begin to care when they start thinking longer term. The real issue, when I first started in the finance industry, people did not talk about whether 1 penny move in the earnings in the quarter was going to move the stock down 15%. But you have a 24-hour news cycle, constant talking, no fact checking, because people make up their own facts and they can't wait. And so things happen, and a tremendous amount of technology. You have to have a focused discussion about what I'd call a lens in the organization and a conversation at the top of the house. That also says, from where I sit, it's not just shared value, shared growth. And I'm a line banker. So I'm not in a staff position where I'm charged with, although I chair our social innovation facility, I am a line P&L assessed professional. In my world, that's important because you then can be very credible at the table about what's going to impact what your clients care about. You need to have a conversation not just at the board level, where this conversation can be held, but it has to be done at the executive committee level and the operating committee level. And most of those executives are being compensated based upon bottom line. So it comes down to how you're assessing in each business, not just finance, but every business, how are you being assessed? One of the more interesting outcomes to watch from crisis, whether in any industry, is the self-reflection that takes place. And how will we assess performance? Within Barclays, which is where we have the shared innovation facility, and I can talk about that later, but within Barclays, you are assessed based upon 5 C's, and within the C's is the community, and it's huge. So you will be looked upon, and you might say, well, does that matter? Oh, yes, indeed, because most of the people who come into this industry are incredibly competitive. So if you tell them what the metrics are by how they're going to be measured, you would be amazed at the creative ideas that will come forward. And, well, I could do this, and maybe I could try this, and maybe this will work. Or if you tell them, witness the social innovation facility, we happen to have money that we can invest in products in your area or services that you're offering if it addresses societal goals to expand the access at the bottom of the ladder or addresses issues within the community global banks, within the communities in which we operate, with a very sizable Africa business as well. We will work with you to reach metrics. You might say, well, I have to have a return on investment within 12 months or 24 months. Well, what if we said you had to have a return on investment within 5 to 10 years, and if we define what investment meant as some non-financial metrics as well? By when you talk about revenues, right, as opposed to am I making money? If I do a fully loaded cost structure, by the way, nothing makes money in an R&D. You have to separate it out into a vehicle that the system doesn't kill, especially if it's replacing something else. It's just what happens in almost anything, especially academia. Okay, I'm on the board of a college. Watch when we talk about doing online courses versus tenured professors. So it is, there's always going to have that kind of dialogue, and that's happening. So I think that you were talking earlier, you're 10 years into the shared growth. Very early days, just starting to come up. I noticed the 50-50. I think you're right. Businesses are somewhat focused on this now, but every single day, better questions, better focus. We've had companies ask us, could we look at how you're assessing your managers on these 5 C's of behaviors? How is that being done? And it doesn't have to be much, by the way. It just has to be on the margin that allows you to say, Bill, you did a great job, but Joe did X, so we're going to give him Y. And then it changes the dynamic immediately. And that is how, it's how algorithms work. They're always on the margin. And so I would say I'm very hopeful.
So you're voting as an optimist. So
Always
this is very good. Barbara is an optimist. May I ask, before I pass the microphone over to Ken, can I just ask you to describe for the audience a little bit more about this social innovation facility that you've created and some of the products that have come out of it? Because it's really quite, it is indeed innovative.
It's different. And what we did is we have a 25 million pound current facility. It will be expanding shortly. And that facility is a set aside of funds that we can use and people come to us from the business to propose ideas that meet objectives. And it can be open. I'd say, well, okay, you can come, what should it be? It can be anything that you can think of that's going to help you in the business. So, and I did mention that one of the early ones we did in partnership with GSK, which was in Zambia, you know, and it's complicated, it's experimental. We probably put, I think, around £3.5 million into that over a 5-year cycle to try. We are the #1 bank in Zambia. We have 43,000 employees in Africa. So what is that? That's an established network. That is where we know the market. So in that particular case, what we're working on is to help the distribution and the funding of alternative distributions of pharmaceuticals, and that's with nurse practitioners, and those become our customers in our banking industry, et cetera, and you grow the economy from the bottom up. One of the things that we just did last year, and this was 3 young women who came to me a couple of years ago and said, you know, people talk about we don't have enough women in leadership positions. We don't have enough women CEOs or board members. Isn't there something that we could do to actually create an investment vehicle for that? There are many correlation studies that would indicate that diversity at boards, including women in boards and women in leadership positions, can create better results. They're all correlation. What we created, because we said, well, who are we and what are we as a firm? We have a huge index business. You'll see the Barclays indices for debt, et cetera. So what we facilitated and invested in from the Social Innovation Facility with co-investment from the index desks and the marketing teams, it was pretty broad, as well, is a Women in Leadership Index. And it is an index that has an exchange-traded note facility, which creates liquidity in the marketplace. It's an algorithm. It's filed with the SEC. It's 5 years back-tested. It's dynamic. And that would be it should be 100 companies across 10 different S&P and industry sectors that have either a 25% woman on the boards and or a woman CEO. It's currently 84 companies, and it has about an average of 34% women on the board. It has outperformed. It outperformed historically, and it has outperformed in the last 12 months. I will let you know that those 16 companies that are missing are predominantly in the energy sector. So that has been a bit of a boon in the last year, and since they've been out of that particular sector. But what is interesting about this dynamic, it just is, okay, then there are other, we do something called Pennies for London with our credit card business. We have a Dream account here in the US that is helping kids, that is an experimental account that actually we found that students, if they invest and begin to save, and we've combined it with skills-based educational consulting with kids in high school. We're experimenting with this down in Delaware right now, which is the base of our credit card business. That's being funded to the Social Innovation Facility. But we will do this across product levels with the hope that the purpose of these index funds, we also have one for disability, is that they will begin to make money, which they do, cover their own costs, and become products. Initially, when we proposed doing this to the index team, this is too much work, we don't really want to do it. As soon as they could figure it out that they could make money on it, and that somebody would fund the initial investment, it caught fire. And they're the ones who've come back with multiple proposals for other particular products.
So thank you. That gives a real illustration to the road you're on, and the fact that we are, as we know in this room, everyone is learning by doing. This is not, we're learning by doing, and it's great to see that kind of innovation at Barclays. Now, Ken, tell us a bit about your 7 years in the private equity business. You joined KKR 7 years ago, again, from the public sector, so you clearly have a deep understanding of social issues, which you bring then into a renowned private equity or buyout business. Tell us about the road that KKR is on, and in terms of shared value.
Sure, and first of all, thanks for the opportunity, and for everyone who's here for what you're doing. Obviously, as was noted, this doesn't occur top down. This occurs incredibly organically, very much bottom up. And Doctor, your comments were awesome. And for those of us that are investing in Africa, it was great to hear, and thank you for your leadership. The approach we've tried to take, I really think, falls into what I would say are 3 buckets. The first bucket is the opportunity to make better investments by understanding certain social trends and thereby investing against those trends in solving problems. The second is ways to take existing companies that aren't ESG intentional but make them ESG better. And the third, as you noted, is to avoid the risk, which is reducing your either reputational issues, your license to operate risks, et cetera. So let me briefly describe each of the three and how they've applied at KKR. So in the first bucket, we've over the last 7 years, I would say, put about $2 billion to work investing in what I would describe as ESG intentional businesses. These are businesses that are first and foremost emphasizing bottom line profits and returns. But the way they're accomplishing that is by focusing on solving a societal problem. I'll give you a few examples. One of the largest areas we've done this is in safe agriculture in China. So right after, you may remember, the tragedy involving baby's milk formula being tainted with melamine, our China team spent a bunch of time trying to figure out and talk to some of the smartest folks in agriculture in China about why that happened. And a big reason why that happened is that in some ways things are reversed in the United States. We look for small local farmers that we can buy stuff from. And in China, if you're looking at a small local farmer, very often they don't have the same standards, the same safety standards, the same health standards that a larger enterprise would. So we decided, what if we tried to essentially roll up a group of smaller farms, put in a whole bunch of capital, and essentially put in the kind of standards you'd have in a United States or a European farm, where veterinary care is involved throughout, where it's fully vertically integrated. So from the breeding of animals to the seed that they eat, to the care for the animals, to their slaughter, to the packaging of the meat, of the cheeses, in this case it's the dairy that are provided, to the labeling. It's all under one set of care. There's incredibly acute focus on potential disease control and prevention, and it turned out to be a home run investment. We've subsequently done a second investment in the dairy space, as well as a chicken investment and a pork investment. If you eat at a hotel in China, if you eat at a Western company, whether a McDonald's, a Burger King, et cetera, in China, it's our chicken. I can almost guarantee you. Because the chicken in this business is chicken that has these standards, which obviously these companies, these brands want. And so in a place like China with their growing middle class, that's a critically important area where you can do well and do good, where the investment thesis can be solving a problem. We've also invested about $1 billion in renewables. We've done that in France, in the United States, and in Spain. We've done a fair amount of investing in what I would describe as sustainable use of natural resources. So in Australia, we have a company that we've invested in. Again, we're building up. It's a really interesting company. 85% of Indian sandalwood, which is very sought after around the world, comes from old-growth forest. And if you think about it, that means a whole lot of it's illegal. A whole lot of it is inappropriately harvested. So we are building the largest in the world ever sustainable Indian sandalwood forest. We're building it from the ground up using sustainable practices. Another natural resource company that falls in that category is a company we just bought called Sundrop. It uses seawater and solar power to essentially grow tomatoes. And so we think if you think about water shortage issues all over the world, this provides a critically important solution. In India and China, we've invested in companies that are essentially non-bank finance companies. One of the challenges in both places is if you're not one of the really big enterprises, your access to capital is much limited. So small and medium-sized enterprises, we're their capital provider in these countries. There are a number of others too, but that is one bucket. And I think those opportunities are only going to increase. If you think about where growth is the fastest, where actually returns are going to be the best, it's going to be emerging in frontier markets. It's going to be the fastest growing parts of Asia, all places where what we know how to do, and I'm speaking as an American, including solving problems, whether it's natural resource related, whether it's environmental remediation, whether it's health and safety, are all things that we can we can actually invest in companies or build companies that provide solutions to these. Second reason I think it's such a good opportunity is look at the post-financial crisis. Some pretty important things that governments used to do, like providing for infrastructure. You saw the tragedy that happened yesterday between Philadelphia and New York. Like make sure that people's retirement is secured, are things government can't do by themselves anymore. They don't have the capital to do it. And that's where private investors can, again, find ESG intentional solutions, whether they be companies or other ways, in order to solve problems. So that's the first big bucket. I consider this to grow a whole lot. The second bucket is investing in more traditional companies and improving their ESG performance. So in 2008, the year I joined KKR, we started a partnership with the Environmental Defense Fund, a group that Fred Krupp leads, that got its real start back, some of you may remember, when there was a lot of questions around McDonald's and the packaging its sandwiches were in. It was in styrofoam packaging way back. And the public, and including a lot of their customers, didn't like that because the styrofoam wasn't biodegradable. So there was a whole campaign against them, the McToxic campaign. And as unfortunately is often the case, the typical company response was to prepare to fight. And Fred Krups went to them and said, instead of fighting, you can actually save a whole lot of money by using biodegradable paper. It's a win-win. Your customers will like it. You'll save money. And from there, they've done this at a bunch of other companies. So we've got a partnership that today is at 27 KKR companies that has saved us $1.2 billion over the last 7 years. And it's all around a simple premise. And that is, the more energy you use, the more money you spend. The more water you use, the more forest products you use, the more waste you generate. And so we work with our companies to develop operational changes. At 2 of our companies, it began at Sealy and U.S. Food Service. It began by essentially training the drivers of what they were delivering, mattresses or food, to much more thoughtfully plan out their routes and use a whole lot less fuel. It included a company, we had the largest brewery in South Korea, and it turns out if you take the boilers and you make them biomass boilers, you save a whole lot of money, use a whole lot less water, and your customers, who are typically younger and care about the environment a whole lot, are happy to buy their beer even more so than they were before when they find out about that. At Dollar General, we began an effort involving recycling with their products came in. Huge effort that had huge bottom line benefit. So this is an example of one of the programs we have that has double bottom line benefit. We've similarly started a program, another area we think you can do good and do well that isn't ESG intentional but makes a company better, involves hiring veterans. So if you think about it, the men and women who have served in the last, say, 10 to 15 years of wars are typically unbelievably adaptive because the wars have required it. They're technologically incredibly proficient. They're incredibly good self-starters, but because we've been at war for longer periods of time, and as a result, their service periods have been longer, it's often a lot harder for them to transition into the private sector and to stay with the job. So we started a program. We brought together our folks who, at these companies, lead HR and lead hiring. We've hired 28,000 veterans at KKR companies. And our goal is to increase that even more. Another area we think you can kind of have a double bottom line benefit without having an ESG intentional investment is around worker wellness. The whole debate over the Affordable Care Act highlights a huge issue we all deal with, which is the cost of health care is going way up. So what if you create, as we did, an effort that says we're going to give an employee $250 a year to get annual biometric screening, and then we're going to measure in out years, what does that mean in terms of a population of employees with respect to employee engagement, with respect to reducing missed sick days, with respect to counseling we offer folks about how to reduce their blood pressure or how to exercise more or how to have better work-life balance. That today covers 198,000 employees at various KKR companies. So that's kind of the broad second bucket. There are other efforts I could speak to as well. One involves sourcing and responsible sourcing, but they're very operational, and they're things that wherever the company is, day to day are critical to operating in the company. Then the last, as you mentioned, involves social license to operate. And that is, how do you invest in a company and make sure you understand how that company is perceived by their regulators, by the public, by their customers, and is there a way to avoid risk with respect to the company? How do we accomplish all of this? I lead a team. We look at every single investment in our private equity portfolio, our real estate portfolio, our special situations portfolio, and our infrastructure portfolio. And we assess its ESG footprint, we assess opportunities, we assess risks. It's about 350 companies every single year. I look at and assess, figure out how they can do better, compare with the company's leadership, how they think about it, how they see it, their strategy to manage it, as well as looking at these trends like I described, like safe agriculture in China, and partnering with our regional teams to help them think about how we can invest against those trends. I think we have a few advantages in terms of accomplishing this. One, long-term capital. The capital we get is typically long-term, long-dated. The investments we make, certainly in private equity, real estate, and infrastructure, are typically measured over years, not quarters. That helps you get a longer period to accomplish this. And the portfolio model allows us to really compare and contrast how things work at one company with how they don't work or how they do work at another company.
Ken, can I ask you something right there? Because you talk about one of your advantages, you have long-term capital, and I'd like to ask both of you to address let's put the pessimist hat on, because you've just been giving us very compelling evidence that the investor community is clearly on the shared value road. But what stands in our way? What stands in our way? I'll switch first to Barbara and then back to you, Ken, which is what stands in our way? What prevents this movement towards creating shared value at a corporate level in the investor community? What prevents it from taking off? And is it the short-term, long-term? Barbara first, what stands in the way?
I think it is short-termism, but it's also, it's not just from the corporate side, it's from the customer side. So if you have a choice of, I asked somebody earlier, I said, if I said you could do X and it was socially responsible and you would get $100, but if it wasn't socially as responsible, although and I gave you 1,000, what would you do? And the person said, take the 1,000. So, well, what if it were 150 versus 100? Well, I take the 100. So the focus on performance, for me, and the private equity markets have long-term capital. They have the luxury of being able to make these decisions because they have private partners. They also have the tension back from those private partners, many of which are public pension funds and endowments and people who can put discipline to them. I'm not suggesting they don't have it. But the public markets, as you turn on that TV or notice every day as to what's occurring, oh, XYZ missed by a penny and their stock is down 17% because the trajectory of their business model, yeah, usually that's not the case, right? It's not going to be that one penny. It's just that somebody's reading it into it. And also, we don't have a lot of fact checking, and we have a lot of talking heads. And we have institutional focus and enormous liquidity, a lot of algorithmic trading where people will go in and out of the market. So you have a lot of technical things going against you, and you have people being measured on their performance, investment managers measured on their performance in day-to-day. That being said, I think there has been a great deal of shifting in just a very short period. You've been around 10 years. I've sensed this tone just in the last 2 to 3 years from the investment community focused on measuring what matters and doing what's right. So asking those questions, and you'll even begin to sense it when you think, and I would credit, this will be an odd statement coming from where it'll sound odd, but a lot of the activist investors, the tactics that they have taken in terms of restructuring companies, you can take the very same tactics and ask those questions to be constructive, to focus on measuring what matters. That does not mean necessarily levering a company up to the gills, stripping out everything. We're talking about measuring what matters for the longer term. But a great deal of this has to do with the short-term focus on maximize current return versus investment over time. You also want to look at what's the average tenure of a CEO of a public company right now, and what was it 10 or 15 years ago? It's about half of what it was. Right now, the average tenure of a CEO of a major publicly traded company is 3.5 to 4 years. So when you take that into context and how to make an impact and how you're going to be assessed, it would actually call that you would ask boards, as informed by investors, to be measuring over a longer period of time and what are the goals, what are the end games, what are you trying to get to? And I think this is a really critical discussion. I think combined with, as a parent of 4 millennials, the questions I'm asked, what are you doing about this? What do you do? Those are really important questions, but also the education to understand how the world is actually operating, where those returns are going, and how to measure what matters. And that is, it has been my experience, if you're measuring it, people will perform to metrics. That's why it's so critical.
Very good. Well, I think that's something we'll all remember, is measuring what matters for the long term. By the way, if you could, please submit questions, because I'll be able to take them on the screen shortly. But I'll then turn to Ken. What stands in our way? What stands in our way? We've just heard that if CEOs have an average tenure of 3.5 years, long-term thinking isn't an easy thing to do. What else? What stands in the way of people, of investor community, not just KKR, but more broadly, really thinking long-term, measuring what matters, and integrating societal efforts into business success, linking those two?
Well, a couple things, I think. First of all, I think we should not underestimate, these are hard things to deal with. This is like someone describing how do you operationally improve things in a company. A lot of these are tough questions. They have tough trade-offs every single day. You operate a large company or a small company. you have to make very difficult trade-offs every single day. The world is more, not less competitive every day. The barriers to entry are lower every single day. And so one is the inherent difficulty of operating an enterprise in 2015. Secondly, related to that, I think, is the attention deficit all of us face because of the amount of information we're besieged by. So, a wealth of information creates a poverty of attention. And what that means is that if you're running a company, particularly a large company, there are 15 different things people are asking you to do every single day. So how do you make this a priority? It relates to the first point, but it's a different one. In some ways, the very factors that have increased and enhanced the focus on these things, the greater transparency because of social media, the rise of the millennial consumer, the recognition, whether it was through the BP oil spill or other things, that there are externalities that we have to deal with as a result of our operations. All of us do, no matter what business we're in. All those things force this forward, and all those same factors, though, honestly, if you stop and think about it, also create impediments because they create other things that you have to worry about and other things that are challenging. So those are all, in my opinion, impediments. But I do think if we put it in perspective, something which at one point moved at a snail's pace and was kind of academically debated is now very mainstream. And you're hearing from two pretty mainstream institutions that are very focused on this. And I don't think we're different than a lot of other folks in the same space. I do think this will continue to accelerate. There's almost like a Moore's law of shared value that will continue to accelerate and every single year get even faster and grow more quickly. We have, since we started this, we have raised an additional $1 billion from investors around the world who are either labor sensitive or environmentally sensitive because they think, and we've worked to customize what we do, but it's our basic mainstream investment strategies, new capital that we never had before because of this.
That's fantastic. So as two mainstream investors, and we have a lot of people from very different sectors in the room. We've got government, NGO, academia, corporate people, private sector represented. Speak for a moment about the roles of the different players, and then I'll start to get some fun anonymous questions on the screen. But what are the roles, what's the role of government in this, in facilitating or not shared value? What's the role of the NGO? Do the investors need to work with NGOs or academic partners?
Well, I would just say a couple thoughts. One, I'll speak to NGOs, I think, can have an incredibly positive role. In our situation, Transparency International, Business for Social Responsibility, the Environmental Defense Fund, the American Heart Association are folks that are operationally, regularly involved in our companies. And they're just a few examples of across the portfolio in many different places. So I think NGOs, provided that they think about this the way, for example, Fred Krupp does. I mean, again, if you stop and think about it, if you have the ability to influence massively, there's two ways you can look at it if you're an NGO, in my opinion. One is to say, I'm going to really emphasize the breakthrough cutting-edge technology to accomplish my mission, or I'm going to really emphasize pushing this company to change in a way that's more aggressive. Let me just give you one example of a company that you wouldn't normally think of as like very forward-leaning, but it's incredibly forward-leaning. Dollar General. Dollar General probably employs 300,000 people. Dollar General, we're out of the company. We invested in it until last year. It was a company that is based in the South. It's a company that always was a great company, but was old-fashioned. And over the 7-year period, this is a company that went from having an okay to an absolute world-class responsible sourcing initiative and approach. A company that developed a recycling program and a store heating and cooling program that absolutely leads the industry. A company that went from a 0 to a 75 in the Human Rights Campaign LGBT employment equity rating. And a company that leads, probably they've hired about 15,000 veterans. And so when you think your normal thought of like a company that's changing the world, you wouldn't first think Dollar General, yet it is. And so I think as long as the NGO community approaches the world and says, anybody can change, anybody can get better, if we work and we approach them in a constructive way, there can be huge positive impact when it comes to that. I'll say one other one from my time in government. I think government can be incredibly positive. I don't think the answer is to say you must do this. A model for me of how you might apply it in a different environment is what President Obama did with education, with his race to the top, where essentially they said, here's a pot of money that if school districts, you're in charge, local control, but if you do innovation and innovative programs when it comes to retaining the best teachers and it comes to figuring out how to be rewarding of merit, we'll match you with dollars. If the government looked, for example, if you want more infrastructure, imagine a program like that that said, if you have a P3, so you get private capital, and you have innovative approaches with respect to it, we'll provide additional government dollars. So create incentives to encourage people to adopt some of these things is one way government can help, I think.
Fantastic. Well, I'm afraid now I'm going to ask Barbara. I can't resist. I'm afraid
I'm
this one has...
looking at it.
I
We're
know,
a stone's throw
it
from
has your
Wall
name all
Street,
over it.
You know? Okay, and you're not throwing stones at me. That's even better.
No stones.
So let me say that I disagree that investment banks are, first off, we're an investment bank. And it is, and guess what? I was a Lehman Brothers investment banker. You might have heard of that firm for 28 years. And conspicuous by their absence. No, they're not. They are, and you know, I don't sit around normally praising my competitors, but Goldman Sachs is right next door. They're doing a tremendous amount with their foundation and capital. JP Morgan is, Deutsche Bank is, almost everyone is. You don't read a lot about it. Who wants to write a story about a good investment bank? You know, it's not going to happen. And it is, so it is, it's because no one wants to read that yet. There will be a time, but you're going to spend your time, I'm Catholic, in purgatory, there for a long time, right? So it is, you're going to be there, but it is, it's not a long tail strategy. In fact, it may turn out that the best thing that ever happened for shared value is that Wall Street crashed and burned. Because when you fail miserably, you learn lessons, and we all fail, right? Hubris is really bad. So you stay low to the ground, stay true. What will strike to their stomachs? If we don't have a strong stomach by now, we're never going to have one. So I would say, when you think about it, I agree with, I like structured partnerships, approaching it a little bit different. We don't own companies. We're not in the merchant banking business anymore. What can we do? And we're doing stuff like, well, who are we? How are we differentiated? And every firm will be somewhat different. Who are we? What are our core strengths, our distribution strengths? Where are we operating globally? Where we can partner with NGOs, where we can use who we are and what we do that is distinctively different. For us, that might be in Africa, where we have 43,000 employees. We have distribution networks where many companies don't have them. We have the ability, we have a huge agricultural finance unit in Africa. So we are working with the Gates Foundation. We work with the Rockefeller Foundation for technology, so that the farmer with his cell phone can tell you what the price is in Chicago today of what's happening and what that price should be. How do you create that? We are not experts in pieces of this. Other people are, and we work with them. I think that's where the future goes. I think you have these large financial institutions that have tremendous information and access, because capital is the lifeblood of business. And be careful when you're investing. Ask the right questions. You know, when you think about it, one of the things that I have found is I have defended companies from takeovers or any number of other issues, is oftentimes it will be the pension fund of the company that's investing in things that maybe aren't so great, right? That don't have, where the questions haven't been asked of those companies, of the funds that they're in. You know, are they doing the right thing? And I'm not talking about, in this case, you know, carbon footprint or anything like that. I'm talking about companies' value systems and where you're investing. If the investor is asking those questions, and big institutional investors, that's a great place to start. Big institutional investors are saying, well, you know what? We don't want to be in the payday loan business. We think that is not where we'd like to see you invest. And in fact, if you do that, we're not coming into your fund. We don't want to be in XYZ. You'll, trust me, the money will go. We'll not fight that issue. We'll go to where the return is. But it's incumbent upon all of us. If you're in an NGO, why don't you go ask the people managing your endowment what they're investing in? How about that? I bet you don't know. And so you should. What are you investing in? What are the policies for investment? What are the tensions that you face? And it is because everything has to be funded. The money has to come from somewhere.
Thank you. Thank you very much. Well, I think we've had some real cause for optimism, frankly. It's been exciting. It's been exciting to have these two people on the stage. We've heard some of the most optimistic statements, and for all the NGOs in the room, you've heard it, anyone can change. So your job is to help facilitate the change. We've also heard that governments can provide the incentives for more creative thinking in terms of shared value. You also said, Barbara, who wants to read a good story about an investment bank? Well, frankly, next year we want to have another good story about an investment bank, and I think we need to learn, Justin, if I can just say, we need to hear more about some of the dynamic thinking that's going on in the investment banking world and in the investor community writ large, because that is so much part of this equation. So our job and your job is to make sure we do hear more of those stories next year. So thank you very much to both of you.